Welcome back, Mr. Routledge. Thank you for your service to the country and keeping our financial system safe. The Competition Bureau has recommended that that we consider changing the stress test for people who are with uninsured mortgages. The government has changed the requiremts, or at least indicated that those who are insured don't have to do a stress test on renewal, so they can shop around and get a new lower mortgage rate. Is OSFI considering changes?
Thank you, Mr. Chair. So to start with the facts, the member is absolutely right in his facts. If you have an insured mortgage and you seek to renew it in an alternate lending institution, you don't have to go through mortgage stress tests or any other underwriting check. By contrast, if you have an uninsured mortgage, you do. And that is an imbalance. And the Commissioner of the Competition Bureau and I have spoken about that. From our perspective, our job is to make sure institutions underwrite mortgages safely. And one of the core principles of underwriting mortgages is, if you have a new credit, do all your underwriting discipline. And so in our view, for uninsured mortgages, which B20 applies to, we ask lenders to underwrite new customers in full. Meanwhile, that doesn't apply for insured mortgagors because they have purchased a mortgage insurance policy.
Okay, I'm going to run out of time. So the question is, are you reconsidering for uninsured
Not
mortgages?
at this time, no.
Okay. So do you believe the government made the right choice, or did you advise the government when they made the choice on insured mortgages?
From our perspective, the rules from an underwriting standpoint, what is sound underwriting, makes sense to us. If you're taking credit risk new, you re-underwrite. If credit risk stays with the same counterparty, in the case of mortgage insurers, we don't think you need to re-underwrite.
Okay. By definition, uninsured mortgage holders are less likely to default. They have more equity in the value of a house. Why are we asking uninsured mortgage holders to effectively cross-subsidize the mortgage rates of insured mortgage holders?
Mr. Chair, what we ask financial institutions to do is underwrite new credit risks. I acknowledge that there is an imbalance from the experience of a borrower who doesn't have mortgage insurance as opposed to one that does. It's an imbalance we accept because of the sound underwriting principles behind it.
Okay. If the government has made a choice on insureds, we're creating a two-tier kind of borrower, where the borrower that has less risk to default actually it has more strenuous stress test requirements. In 2021, when stress test came in, I supported that because it made sense, because rates were at an absolute rock bottom level. We're now at the top of the rate cycle, which is according to central banks. Shouldn't we be giving consumers a little bit more flexibility to shop to get a better rate?
Mr. Chair, our mandate is prudential, to ensure that the lenders who provide mortgages are safe. We think in maintaining sound underwriting policies, which includes re-underwriting or underwriting new credits, even if they're switching from another institution, that's the appropriate thing to do.
Okay. Thank you. I'd like to talk about Basel IV for a second. The Fed has been very clear. They are making material changes, may even include delaying, may even put out new rules for comment again. They said they have never seen as much feedback on these new rules as possible. Why is Canada sticking to an accelerated timeline to implement Basel IV?
Mr. Chair, in implementing Basel IV, we also call it Basel III Endgame, but in implementing the new changes from Basel, Canada is actually behind its initial schedule, but ahead of most of its peers. We moved on these because they're based on sound prudential principles that lead to a more stable financial system in our view. With respect to the final leg of the changes we're making, which is known as the standardized floor, which very complex, but it's basically a check on the models banks use to allocate capital. we are well ahead of our peers. And over the last 9 months, it's become quite evident that our lead will at least stay the same or increase. And for that reason, we've been engaging with industry to consider what the right schedule should be for that rising floor. And we'll have more for you on that this summer.
Thank you very much. So you're aware that at least some banks have said in the Canadian context, it may require banks to shed about $270 billion of risk-rated assets. Like, you don't dispute that that may occur?
Mr. Chair, my math doesn't quite align with that math. But what is indisputable is that a rising floor will increase risk weights, which will therefore increase capital. And while we think that is a sound approach, it is imbalanced with our global peers. And that imbalance, the industry players argue that that is an imbalance we need to look at. We would agree with that, and we've been looking at it.
Last question before the chair cuts me off. Will you commit to not making a decision until we see what the U.S. decides to do?
Mr. Chair, I don't want to make any firm commitments here today until we're done with the due diligence behind this process, but perhaps I could come back to that answer later this summer.
Thank you very much.